I think we're well equipped to start this session, which is about supervision and stress testing. So welcome to you all. I hope we'll be having an interesting and interactive discussion. To introduce this session a little bit, let me say a few things. We'll be focusing on stress testing. Now, that was a tool that wasn't used that much, but the great financial crisis changed that, and I would say since then there have been vast developments in the way we execute stress tests, the types of risk we focus on, and now it's one of the tools that we're, amongst others, employing to assess climate-related risks. That has to do with the amount of uncertainty involved, the non-linearity of how these risks evolve, and also the fact that we're talking about tail risks in a sense. So you have to think about scenarios and really see what the impact on the sector would be in these different scenarios. Now, I think one of the first major stress tests that was performed in the European sphere was in 2011 by the European Banking Authority. So that was given the uncertainty about the quality in bank balance sheets, a transparency exercise. So it was one of the first times that across the board they tested these significant institutions' resilience and published those results. I suppose the journey since then has been rich. For example, from my own experience at the Dutch Central Bank, I'm in financial stability at the Dutch Central Bank. We started with regular stress testing, but we've evolved that tool to, as mentioned, also assess climate risk. So it was in 2017 that we developed our first energy transition stress test, again, to capture this uncertainty about the different pathways and how risks would materialize in each scenario. I think we were relative first movers in that area, and that energy transition stress test was also an example for what we've been doing in Europe since. We've evolved from that first exercise, and most recently in this area of sustainability, for example, done a flood risk stress test. As you know, the Netherlands has a certain geographical location, so we were thinking which physical risk to zoom in on. So we've been focusing on the nexus between real estate and climate, and been assessing the flood risk to financial institutions and seeing stress testing, sort of reverse stress testing, when floods would actually become a financial stability risk in the Dutch context. Similarly, also focusing on that nexus between climate and real estate, we've done a transition risk assessment, looking into retrofitting costs. So looking both at residential and commercial real estate, some of the energy labels these buildings now have, what would be required in terms of capital investments if they were to adhere to stricter regulations as regards energy and sustainability, what it would mean for households and firms to make those investments, and whether they could actually carry them, and when it would become a financial risk. So just to give you a bit of an idea of how stress testing has evolved at the Dutch Central Bank, and perhaps some of you were here for the session before lunch on nature finance. At least in our case, that's a bit the next frontier. So we're currently seeing whether we can move beyond climate and actually look into nature-related financial stability risks using similar stress testing tools. We are not the only institution that went through such a journey. We have quite knowledgeable speakers at the table currently. I think the field has grown significantly, and there's so much valuable work going on. And especially in this context of sustainability, it's a very useful tool. So we'll hear a lot about it today. So this session focuses on current best practices, the future of climate stress testing, as well as the potential over the next 10 years. Not a small topic, and let's see what we can tell you guys about it, and I'm also very curious to hear from you what some of your questions and experiences are. So perhaps I should quickly introduce our speakers. So we have, first off, in a minute, Irene, who is head of the Climate Change Center at the ECB. Next up, we'll have Joe, next to me, who's a Senior Director for Financial Services at Willis Towers Watson. And finally, we have Nicola, who is Head of the Sustainable Finance Research for Development here at the Oxford Sustainable Finance Group. So with that, perhaps, Irene, I can pass over to you, and it would be great if you can tell us a bit about the journey at the European Central Bank, hopefully also the most recent landmark work that you've been doing with the climate stress test, and anything else you would like to share in terms of opening remarks.
Thanks so much, Saskia, and hello everyone. I'm very pleased to be here with you today. I very much enjoyed yesterday and also this morning to learn from everyone and hear all the insights. I'll tell a bit before I dive into the results of the supervisory stress test of indeed the journey the ECB has gone through. Because addressing climate change and supervision is not the only thing we do. ECB has a wider mandate, and what we're doing, we're really taking actions at all fronts. So last year we executed a monetary policy strategy review. The conclusion was that, okay, we need to address climate change in our monetary policy work. So we published a climate roadmap coming out of that, spelling which actions we're taking from now till the end of 2024 on addressing climate change in our macroeconomic models, in our statistical work, and also in our monetary policy operations. And on the last bit, we just published on the 4th of July the actions we are taking on the monetary policy front. So we're not talking about that today, but I think it's important to mention it because I think it gives a big signal to the market. There we published how we are going to take into account climate change in our corporate bond purchase collateral in our collateral framework, that we're introducing disclosure requirements for our collateral and also for our risk management internally. What are we doing about it? How can we improve our own internal risk assessment on climate? And also what do we want credit rating agencies to do at that front, to have them, so we really urge them to be more transparent on their methods they're using and disclose that more, so we know where we rely on. And I think that counts for a lot of people present here today, that they have that need as well. So that's the monetary policy front. Of course, there's financial stability. We have a task there. We have banknotes, so we're really saying how can we produce banknotes in a more sustainable way with a less environmental footprint. And of course, there's a supervisory work. But today here we're talking about stress tests. And there, I think it's also nice to share with you that we're stress testing in 3 different ways already. So last year, we published the results of our economy-wide climate stress test. That's from the financial stability side. And this exercise tested the impact of climate change on more than 4 million firms worldwide and 1,600 area banks under 3 different climate policy scenarios. And there, I don't think this conclusion is shocking for you, but I think it's important to say that the exercise shows the advantage of taking action early on outweighs the initial cost over the medium to longer term. I think this is just a call for action, that we really need to address climate change as soon as possible and make an orderly transition. So that was one stress test on the financial stability side. At the moment, we're also executing a pilot stress test on our collateral framework. Is that stressed enough to climate risk? And thirdly, the supervisory stress test. And I have some slides on that, which nicely visualize the exercise we've been going through. So let's see. I get them on my iPad as well, so I can easily see what you're seeing as well, without turning around. Yes, we're on the same page. So our supervisory climate risk stress test. This is what we started in the beginning of this year with 2 objectives. Optimize banks and supervisors' capacity to assess climate risk and enhance available information on climate risk stress testing. So the timeline was from January till July 2022. And it was a real learning exercise, and it was not only number crunching. It was based on 3 modules. The first one was a qualitative assessment of climate risks stress test framework. So how do you organize yourself? How do you embed it? The second module was a stock take on sustainability of banks' incomes and finance greenhouse gas emissions. And the third module was the bottom-up stress test. The scenarios we used were based on the NGFS scenarios. I'm not sure if you're familiar with that, but pretty high over, hothouse world, disorderly transition, or an orderly transition. And we did a short-term risk of a front-loaded rise in carbon prices, that it was in 3 years, and a long-term transition path under different scenarios over 30 years. That was the transition path, transition risk scenario. For the physical risk side, for Europe, we did a flood risk and a drought and heat risk, both for 1 year. And what was the scope? Well, we took a sample of 104 banks for the first 2 modules. For the third module on the bottom-up stress test, we only included 41 banks, because those we looked at the proportionality and thought, okay, this is the sample we need to take to make it meaningful. Yeah. So what were our main findings? Overall performance was banks managed to submit a large set of innovative qualitative and quantitative information. But around 65% of the banks scored poorly and showed significant limitations in their stress test capabilities. And a large share of banks don't conduct an in-depth climate risk stress test as part of their ICAPs. So you see the scores on the right. Our findings were that banks need to further work on improving their stress test frameworks and governance structure. So really, how do you embed it in your whole company? Improve data availability, and improve modeling techniques. Now diving a bit deeper on the findings we had in these 3 different modules. So the first one, how do you organize your climate stress test internally? So around 60% of banks do not have a climate risk stress testing framework yet. The climate risk coverage, transition and physical risk requires further enhancements. And most banks have not yet included climate risk in their credit risk models, or just 20% consider climate risk as a variable when granting loans, just 20%, right? So we have a long way to go. And a large share of banks do not use climate risk stress test outcomes for their business strategy. So here you see a bit of a siloed approach, right? We know things there, but we're not really integrating it in the whole work. On module 2, so that was really what are the exposures of banks. We found that more than half of banks' income from non-financial corporate customers comes from greenhouse gas intensive industries. Well, basically, this is probably a reflection of the real economy, right? So that's where we see where the big changes need to be made. We reported sectoral income as a significant advancement for climate discussions. Our other finding was that banks lacked actual data regarding greenhouse gas emissions availability. So around 70% of the reported scope 1 to 3 emissions rely on proxies. And proxies are a good first step, but they can create deviations in the results. So we need to urge banks to have more customer engagement at this front. Moving to the stress test. So we did these 3 scenarios. The findings were that banks don't have robust long-term strategies and show little differentiation between possible long-term scenarios. Also here, the results, like the economy-wide climate stress test that I mentioned before, here the results also show that an orderly green transition will lead to a lower loan losses than a disorderly inactive one. And if we're talking about numbers, the credit and market losses amount to around 70 billion on aggregate for the 41 banks that were included in the short-term disorderly transition and the 2 physical risk scenarios. But I do want to put a caveat on this number, because maybe 70 billion doesn't mean much to you, right? Maybe you can absorb it. But this is a learning exercise, climate stress test, right? So we're pretty sure that we're not covering everything yet, because there is a scarcity of currently availability of data, the bank's modeling only capturing climate factors rudimentarily, the exclusion of economic downturns from so the economic downturns from scenarios were not included, and more importantly, the included exposures only account for 1/3 of the total of the exposures. And there was a lack of supervisory overlays. Finally, banks were unable to allocate 17% of the reported collateral to an energy performance certificate bucket, even using proxies. So that's quite some numbers, and I think here we have a lot of lessons we've learned. So let's move into that. So what we found on a positive way, and I think, Saskia, you said it's a road we're on together, and also here, like, we've going somewhere, and there are positive signs, right? Banks manage to report comprehensive and innovative information on their climate risk test capabilities. Yet they face significant challenges in data availability and modeling techniques. And also for supervisors, we've learned a lot. We gathered valuable insights onto bank capabilities and vulnerabilities, but also ourselves, we need to enhance methodological approaches and bottom-up stress test scenarios. And we also want to help banks overcome the challenge of data availability. And more importantly, we want to provide guidance on best practices. And I think this is something we'll be publishing towards the end of the year. So what are we doing with this? And here I want to take one step back, because this climate stress test is only one part of all the work we're doing on the supervisory side. We started in 2022, December, we published our supervisory expectations. In 2021, we asked banks to do a self-assessment. Where do you stand towards these supervisory expectations we published? And there also the conclusion was that we need to do a lot. There needs to be a lot of improvements. And this year we executed the stress test. We're doing a thematic review, we're doing deep dives, we're doing on-sites. So really embedding it into the veins of supervision. Really the day-to-day work, really moving it from a team of experts toward the joint supervisory teams into their daily work. And the results of this stress test, they will feed into the SREP, the Supervisory Review and Program, from a qualitative approach. And there will be no direct capital impact to the Pillar 2 guidance this year. And all banks receive or have received individual feedback and are expected to take action. And how do we see them to take action is maybe we can help them with the supervisory expectation, or the best practices, the publication of that. And maybe the results can be daunting, right? Because we need to do a lot still, and we're not there at the place yet where everybody should be to really take into account climate risk. There are a lot of unknowns. But I think what stamps me what stamps me really happy, or we have to stay optimistic, right, in this field. I remember like 5 years ago, December 2017, I was there when the Network for Greening the Financial System was created with 8 central banks, a club of the willing, seeing, okay, let's try to do something together, let's move this forward. In October 2018, we published our first progress report, and there we stated, climate-related risk lead to financial risks and therefore fall squarely within the mandate of central banks and supervisors to act. That was a pretty groundbreaking statement at that time. And if I see where we are today, we're talking about stress tests. We're talking about how we can implement it in our monetary policy operations. How are we addressing climate change in our macroeconomic models? And I'm not here to say that it's easy. But if we look at all the practices we gathered over this exercise, if you put them all together, you see that not a single bank meets all of the expectations. But if you put them together, we see practices, and putting them together, it can be done over the full spectrum. So yes, it's not easy. Yes, it is possible. And I just, work with you, work with others to get this done.
Well, thank you, Irene. I'm sure there'll be loads of questions for you later, but perhaps first let's turn over to Joe, because we've had two central bankers following one another, and perhaps now it's time for a perspective from the private sector, although you weren't always in there, but...
No, former central banker.
Oh, exactly.
And the token man on the panel as well, I say. It's, finance has always been this very female-dominated space, so it's good to see that Oxford are in tune with the changing times. No, seriously. Thank you, Saskia. So, let me begin by saying a little bit about supervision, then I'll talk a little bit about some of the central bank reference scenarios. Stepping back, what have we seen in the last 6, 12, 18 months? It feels to me a little bit as though in the run-up to COP26, there was this fantastic momentum towards commitment making by companies, commitment making by financial institutions around the importance of getting to net zero. Firms globally are now turning to the task of implementation, right? So how are they going to do that? How are they going to get to net zero by 2050? What does that mean for their investments, profits, employment, et cetera, and supervisors are facing the same question, right? There's a huge risk here to financial institutions, as Irene just said. How do they best supervise that risk? You know, in the case of banks have this special privilege granted to them by governments, which means that they can take deposits, and in return for that, they have to subject themselves to supervision and capital standards. So what does getting to net zero by 2050 mean for financial institutions' transition risk? One thing we've thought a lot about at WTW, the firm I now work for, is to what extent the global search for net emissions translates into emissions being a good metric for risk at the level of individual firms, right? So if you look at, for example, some of the disclosure requirements we're starting to see, including those from the US SEC, there's this enormous focus on emissions. Sounds sensible, right? If you emit more, you're more prone to transition risk, people are going to take money away from you, investment will fall, your business will be less profitable. It's not always quite as simple as that, is what we're finding. Because not all of the investment that we need to get to net zero at a global level by 2050 is in itself low carbon. Let me give you a couple of examples. If you are in the copper mining business, for example, or the lithium mining business, you are going to be hugely profitable for the next 10 to 15 years, right? Because if you look at sources of renewable energy, batteries for electric vehicles, for example, there's going to be this huge demand for copper and lithium. You're also very highly emitting. Getting this stuff out the ground costs in terms of carbon, right? Doesn't mean you can't get to net zero by 2050, because unlike coal, you can reuse copper wires and you can reuse and recycle electric car batteries. But we're going to need some emissions over the next 10, 15, 20 years from some firms in order to get the global economy to the point of net emissions by 2050. Conversely, it's very easy with a focus on emissions to regulators for financial institutions to sort of do paper decarbonisation, right? Invest all their money in a supplier of IT services to the oil and gas industry. No scope 1 and 2 emissions whatsoever. Well, a little bit, okay, because an IT firm has to buy electricity. But very low emissions in a business like that, right? But huge transition risk, because those oil and gas firms will have to wind up at some point in the next 20 to 30 years. So something we thought a little bit about is this conflation between risk to financial firms and emissions at the level of individual firms. We can all get behind reducing emissions at the global level, but maybe financial supervisors have to be a little bit careful about what they ask of financial firms in the medium term in terms of decarbonisation, because risk to banks, risk to insurers, and the amount of carbon on their books is quite a nuanced relationship. And I hope we can return to some of these themes in the discussion that follows. Very interesting to hear about the results of the work that the ECB has done on stress testing and scenario analysis. I'd like to throw one additional idea into the mix here, and this is around disorganized scenarios, or I think of them as disorganized scenarios, right? So when central banks think about stranded assets or too little too late, they're looking generally at scenarios in which we as a society, as an economy, as banks, continue investing in brown assets, in dirty sources of energy, and then suddenly Minsky comes along, as someone put in one of the earlier sessions, and there's this sudden transition to net zero and all of that capital is laid to waste. Increasingly, I'm worried that we could see the reverse, right? I don't know if any of you are in the session in here looking at what's going on with costs of capital to different sources of energy, right? An opposite but related risk is that all the investment in brown sources of dirty energy starts to wind up before we've fully brought on board the necessary alternative energy from renewables, right? What does that mean? It means a world of much higher and more volatile energy and electricity prices, right? Because the transition between winding down the dirty stuff and bringing in the green stuff is not smooth in some sense. And this is kind of what we've started to see over the last 6 months, right? Albeit for different reasons. It's due to the war in Ukraine, right? We turn off natural gas from Russia, but we don't yet have the necessary solar and wind to entirely replace that at short order. Electricity prices go sky high. This could become pro-cyclical, right? The UK Prime Minister, or the former UK Prime Minister, says, oh, we can just delay transition by a couple of years, can't we? Let's bring in liquid natural gas from the US. Electorates rise up and say, well, hang on a second, what about those transition pledges? So then we turn off the dirty energy, and this cycle of higher prices could begin again. So there's a danger, I think, that we wind down the dirty stuff before we can fully bring on the clean stuff, and that this involves or leads us to this new normal of higher, more volatile energy prices. And it's worth thinking through what that means for the macroeconomy, and I would challenge Irene and any other central bankers in the room to think about how they can include that kind of disorganized, unsmooth scenario in some of their central bank reference scenarios. Because to me, it feels a little bit like a missing piece in what we're seeing from central banks at the moment. That's everything I had, but I hope we can touch on some of these topics a bit more in the discussion that follows.
All right. Thanks so much, Joe. Then the final introduction by Nicola.
Thank you, Saskia. So I'm going to sort of build on some similar themes, actually. And firstly, let me say it's a great pleasure to be here, and thank you all for coming to Oxford. It's so great to see so many people here in person. So I'm going to talk about some work that we've been doing in the UK, looking at what we learned from the recent UK climate scenario exercise. And some of the lessons are very similar, actually, to what we've heard from Irene. But I want to sort of look slightly broader as well. So in a lot of this discussion, we've really focused on financial stability. So the key motivation for a lot of what we're talking about at the moment is, that climate change is going to create a material financial risk, both physical, transition, litigation risks, and therefore we need to start building that into supervisory frameworks to avoid a potential significant financial stability risk potentially in the future. But actually everything that we're talking about here has potentially a much greater impact if we do this properly, because if banks begin to integrate these risks more into their regular financial decision making, as Joe said, if we do that well, it should help to shift financial flows. So this isn't just about the banks and about financial stability, which is obviously incredibly important, but if we get it right, this is about shifting finance, both away from high carbon towards lower carbon, but from away from higher physical risks towards supporting adaptation, resilience, supporting nature, etc. So the prize, if we get this right, is very, very large, and this links into the other areas that Irene mentioned as well, around sort of monetary policy, for example, which is also an important enabler. So I'm going to sort of try and talk about supervision, but in that context. So I'll start on what we've learned from the UK exercise. So this is in the context of my work in the Centre for Greening Finance and Investment. We have a collaboration with the Climate Financial Risk Forum. So the Climate Financial Risk Forum is a public-private forum in the UK that basically brings together all of the banks and the insurers, all the big asset owners to talk about how do we manage these risks and to share best practice. It's convened by the Bank of England. And so we did some work with them, and this is very much academic research to look at what was learned from the recent climate stress test in the UK, which you might recall was published in May this year. And all of these, I should say, are very, very early. They're literally off the press this morning. From the work that we've been doing. So we've conducted surveys and we've conducted interviews with the 23 participating banks and insurers. To date, we only have about half of them in, so this is very much ongoing work. But I really want to sort of share some of those initial findings with you. As a little bit of context, so the Bank of England stress test had 3 goals. So one was to support, to encourage participating financial institutions to strengthen their risk management. So a lot of it was about capacity building, awareness, etc. The second goal was about understanding the potential size of the financial risk to the UK. And the third was to encourage the participants to look at and understand the implications to their business models and to begin to adapt their business models. And I should say this is sort of one of a number of regulatory and supervision things that have happened in the UK. So the first thing that we found through the interviews is that actually all of the banks and insurers that participated have said, yes, this had a really big impact on their internal capacity to manage these risks. So if we look, for example, we asked them, did your organisation conduct stress tests before CBES? And actually quite a lot of them were in the camp of either not at all or they'd just started to think about it. So this was sort of a year ago before the exercise began. And we asked them about, well, how has this changed as a result of CBES? And now they're all saying, particularly in the context of their risk management, that this is now a really integral part of their risk management. So they are really integrating climate into their risk management, or 50% of them saying they're starting to do that, because this happened very recently, obviously. It's also really starting to come into their disclosure frameworks in a very active way, where it's not having such a great impact, or a strong impact that we're finding so far is in their business strategy. So they're really thinking about this as a risk issue, not necessarily in terms of sort of changing how their business model is working. And then we asked them about, again, technical capacity, and overwhelmingly they felt that this has really improved their technical capacity for the long term. So not just the short term, but for the long term as well. So the second thing we asked them about, well, how is this then, what are the benefits beyond just the risk management side? And we asked them to, a whole number of things. So, has it improved awareness of risks at your board level? How is it flowing into your discussion with clients? Are you integrating it into your credit risk analysis? And what we find is very, very mixed. So yes, they've said it really improved the awareness and engagement of their board and at C-level within their organisations on climate risk. But perhaps sort of similar to the ECB's finding, actually going into sort of day-to-day credit risk analysis, very few of them said that it was really beginning to come into that sort of day-to-day decision-making. In sort of institutional risk management, it's really starting to feature in there. One area that was quite interesting, particularly when we look at the link between this and what's happening in the real economy, is that there was quite very few said that it had really influenced their discussions with their clients. So it was very much a sort of internal exercise and hadn't really fed through into that relationship with the clients. So that says a lot about how much this is really feeding through to a real economy impact. Part of the reason for that may have been, and we need to dig into that this was so fast. So they only really had a year to do this. So actually time to really engage with their clients was quite limited. But certainly, overall, many, many positive outcomes, but potentially not in every area. And then, how the next thing we asked them about was, do you think that this met the purpose of the exercise? And overwhelmingly they said they either strongly agreed or somewhat agreed with that this met the 3 stated purposes. So the design of the exercise really met that. So I think in terms of, again, this is very preliminary, but in terms of did this exercise really support improved risk management, building capacity? Yes, very, very strongly that comes through. The second thing I wanted to talk about, and there are a number of sort of technical issues that they felt that they needed to be resolved. I'm not sure how much we should get into technical detail here, but things like the static balance sheet assumptions in the exercise, they universally said needs to be sorted out for future assessments. There was a lot of questions over how the baseline and counterfactual was specified. Some challenges that they faced around getting the data that they needed to do it, actually building capacity that quickly was a challenge for them. Modelling physical risks was a particular challenge for them. So all of these sort of things came out. But the next thing we talked about, to what extent did this really help us, do we think, understand the size of financial risk to the UK from climate? And so they said yes, universally, or say somewhat agreed with that or strongly agreed. And we sort of dug into that a little bit more. So we asked them, do you feel that this adequately represents the range of plausible material risks that the UK could experience over the next 30 years, the scenarios that were used? And overwhelmingly they said, it's about right. Given current knowledge, what we were asked to do was sort of represented our understanding of risk. And we dug into that a little bit more, as we do as scientists. We asked them, well, do you think that, did these really capture all the material sources of risk and the key risk transmission channels? Do you think that they were really fully represented in the scenarios? And actually then we found, and perhaps this is consistent as well with the ECB case and also with what the Bank of England itself said, which was that actually there are a lot of risks that were missing in this exercise. So particularly on the sort of 10 to 30 years, 60% of the respondents, and again this is still ongoing, said they felt that some of those key risk transmission channels were not really adequately captured. So potentially this is underestimating the risk. And then a little bit sort of digging into that more, like what are the key gaps in the knowledge then? And we particularly sort of tried to take a reverse stress test approach and ask them, what are you really worried about with climate change? Where do you think, what are the things that you care about that maybe aren't captured in here? And we heard about that, particularly sort of the black swan events. So what if, a Ukraine crisis happens? Is that a type of shock in these scenarios? What if it is a very disorderly transition? So a lot of these like big policy related risks, quick changes in policy were things that they were particularly worried about. Gradual changes in asset values that they mentioned that they were worried about. Demand side and shocks they were very worried about. So they were worried that there could be big changes in investor confidence rapidly in the economy in these high carbon sectors. So these were sort of some of the things that came out. And then we asked them about, because we obviously an institution that looks at analysing these types of risks, what are the gaps in the knowledge? So physical climate risks, interestingly, came out as a really big gap that they all mentioned. So what they didn't feel that there was a really good understanding of the full transmission channels between physical risks to the economy and how that fell on individual firms and what that would mean for them. Supply chain risks came out as a key challenge. Just a broad sort of understanding of the uncertainties and sensitivities in this, these government policy risks, and then the macroeconomic implications of this. So a lot of the analysis was very sort of asset level, analysing risks to specific firms, specific assets that they owned. But that wider sort of, how was this going to affect the whole economy? And what would that mean for banks was an area that they identified as missing. So they're some of the key findings then, and certainly I would say, so I'm a physical risk expert, so maybe this sort of complements what Joe said on the transition risk side. Certainly, if you compare the types of risks that you were looking at in the CBES exercise with what the government's own climate change risk assessment says about the key risks to the UK, you can see quite clearly that there are some big gaps. So if you look at what the UK's climate change risk assessment, which is the risk assessment that the government commissions every 3 years or so, the big risks it identifies are things like global supply chain risks, those sort of cascading risks, risks of water stress, big water stress on businesses, health threats, heat, infrastructure system failure. And a lot of these areas that were assessed in the CCRA, Climate Change Risk Assessment, actually have quite low adaptation at the moment. So one of the interesting things is that the risks that potentially banks and insurers were looking at are actually the things that in the CCRA it says, these are risks, but actually we've kind of got a handle on them. Whereas the big ones that the government's worried about were not so considered. So I think that kind of points us in a direction of where we might need to look in future as we sort of develop these scenarios. And I think I'll leave it there for now, but I think that I can just finally, I completely agree with Joe's point on this. I think we need to think about the wider sort of real economy transition that's being driven by this. And I think there is a risk at the moment. So the financial sector is doing an amazing job at the moment on climate risk. I really feel that they are. But we have a risk at the moment that we've kind of got a dichotomy between the financial sector running very quickly and government not running quite as quickly. And that will create a risk in itself. So I think that's a key thing that needs to be considered.
Thank you, Nicola. I have a few questions of my own, and I will certainly try to abuse my role in order to be able to ask them. But first, let me open up the floor, because I'm pretty sure you all want to get in there. So who has questions? We have a few. Maybe the gentleman in the front, then over there and in the middle.
Mike Clark, that's on, yeah. I have to say I'm an optimistic realist, because we all need to be optimists. But putting my cards on the table, I've just thought that actually we're going to have a survey run by Ben in 6 months asking all participants of this event, have they read Nicola's work? Because it should really scare us. I've described Sam Wood's CBEST speech as unintentional regulatory greenwashing. I think on the back of what Nicola's telling us, we should be a lot less confident. Just turning to scenarios, I mean, the question to the central banks is, how can we help you accelerate? Because we know 30-year scenarios in economics are pointless. 30 years are good for science, but when we say risk, we tend to ignore uncertainty. The uncertainty that pervades risk increases the range of short-term outcomes. So with a couple of colleagues, we're running an initiative called the Real World Climate Scenarios, which says more short term, more uncertainty, more narrative, because one of the phrases that seems to have come along is narratives eat modelling for breakfast. So I guess the question to the central bankers is, I'm glad that Joe spotted Mr. Minsky. I don't know if I take the credit, but Mr. Minsky may arrive while we're doing all this good stuff, which will be a bit sad. So I think the question is, how can we help the NGFS folk accelerate? Because we just know there's so much to do, and Nicola's work highlights the challenge. So how can we accelerate, I guess, is the question.
Okay, we'll take a few more and then go towards answering. Yeah.
Thanks. Tom Gosling, London Business School, and maybe just building a little bit on that. I mean, I was kind of staggered by how small the numbers are, right? So 80 billion, which was an accumulative loss, is about kind of 1/5 of the regulatory capital currently held by banks in the UK only. So it seems to me that either your stress test must be out by 1 or 2 orders. Need to worry about this as a financial stability risk, and we can do other stuff. I'm just wondering which it is.
All right, and we had in the middle of the aisle the gentleman with the blue jacket. Yeah.
Pekka Prine and Climate Risk Services. Just building on the earlier 2 points, noting the significant uncertainties on how some of these scenarios are going to develop, the current data limitations, the methodological limitations that I think you have all been very open and honest about. Do you think that there's a real danger here that we're trying to over-quantify elements that are essentially unquantifiable, that could be leading to these results that could be inherently underestimating the magnitude of some of these risks by multiple times what they actually could be? And is there room potentially here to move toward more qualitative assessments that inherently capture some of those uncertainties a lot better?
Okay, thank you. So we had a few questions. First, how can we help you accelerate? Always a generous offer. Well, maybe Irene can say something to that, and maybe you guys want to do. And I would say the other two questions are related. So the numbers seem small. How come? How should we interpret them? And perhaps it's the shortcomings of trying to quantify. Should we consider qualifying the risk assessment? So maybe I can start with Irene and then see if Nicola or Joe want to add.
Thank you. Yeah, thanks for the great question and the generous offer. As you may know, that the European Central Bank just took over the role of chairing the NGFS scenario work within the Network for Greening the Financial System after the great work that the Bank of England done at the front. So please reach out and see how we can connect. Well, there's always a second chance. So no, please, because here I think I just want to emphasize, and everybody knows this, but nobody can do this by themselves. So we need to have work together, learn from each other, learn from academics, learn from the industry on how do you really advance the work at this front. So really open to listen. On the question on are we trying to over-quantify maybe this? I think here at the European Central Bank, we're just taking a gradual approach. We see what we can do, but we're also with this stress test, it was a lot on the quality. That's why we took these 3 modules, especially the first one. How do you set up your whole framework? Where do we start? And I think this is just the road we're on. I get a lot of questions, when are you moving to Pillar 1 capital requirements, right? Then it's really going to hurt. Well, if we have enough credible information to do so, we'll do that. But we're not there yet, to be very honest. I think the European Banking Authority is currently having this consultation. How much do we have at that front? So we're looking more to the qualitative side of things, and this is the space we're in. Very open about that. The Basel Committee on Banking Supervision has this task force on climate risks. They're also looking into how can we really integrate it into our capital framework of the requirements of the Basel Committee. There we're also taking these approaches, and maybe to sketch a bit how this works from my perspective, how I see the Network for Greening the Financial System. That's a great group where everybody collects information, shares practices in a very club of the willing, friendly environment. And nobody's bound by what the NGFS publish. You can take from it what you think is needed. So it's a really good environment to share openly experiences. And then it moves up to the standard setting bodies like the Basel Committee, like the FSB, like the IAIS for insurance. So this is how it works. And I think we're on this road together. And again, I think it's going quicker than I had dared to hope for at the start. So let's see. But maybe my colleagues can say a bit more on the quantification or other aspects.
Well, maybe if I can add to you, yeah. Because I'm just curious on the back of what Irene is saying. So these NGFS scenarios have been developed as a cooperation between academia and the NGFS members. They are, as mentioned yesterday in the keynote by Bundesbank, a public good. They have been published. They are at the root, for example, of the climate stress test that the ECB has done. But I'm just curious, the scenarios are out there. We developed this. We put a lot of effort in it. How many of you are familiar with them? Like the actual scenarios and where to find them? Well, you see, I would have hoped it would have been the whole room, but it's about half. How many of you use them? I see about 10, maybe 12, 15 hands. So if we could increase that, because I agree, it's this process of co-creation, learning from each other and sort of moving ahead together. So hopefully a lot of people will tap into that and we can cooperate. But sorry, perhaps, Nicola, you wanted to add something?
Just to make a comment, so, and come back on this point about, are the results that I showed scary? And I'm sort of pragmatic on this in that, this world has evolved incredibly quickly, and what we asked financial institutions to do over the last 18 months was a huge step for them, particularly banks on the physical risk side, for example, because most of them hadn't really thought about this before, and probably the insurers on the transition risk side. So actually, I think I sort of see it as a sequence of steps. And so I think there's a huge amount of positives. You know, the fact that actually they're all now aware of these risks and they've built teams. And anyone that's tried to recruit in the last year has realized how fast they're building teams. It's impossible to recruit climate experts at the moment because they're all being absorbed by these big banks and insurers. So, you know, there's a massive amount of positive here as well. And certainly in the banking zone communication in May, they were very clear about some of the risks that were missing. I guess where the things that worry me more, one being that yes, you know, the numbers were very low, to come back to your point, Tom, and it's whether those numbers are overinterpreted. I think if they're seen as this is a first step and then we're going to get better at quantifying the risks over time, I think that's fine. But if it's seen as, oh, the risks are small and therefore this isn't something we need to worry about, then that's a big problem. It also worries me that if we're now using this and are beginning to use this to price into financial transactions, actually we're mispricing and we're not directing finance flows as quickly as perhaps they should be. So there's a challenge there. And I think in terms of the wider sort of public good nature, to come back on the point on NGFS, again, what NGFS has achieved in a very short time is incredible. You know, we've gone from almost nothing to a set of scenarios that we're all familiar with and people around the world are using. And whenever I talk to a bank in, you know, low-income countries, they're all aware of NGFS. But I think the key thing is that we communicate properly. You know, this is a first step. We need to build on it. Yes, there are some key risks that we're not capturing, and we need a process in place to start capturing those risks. So I think that's the key thing.
I mean, for what it's worth, I agree with all of that, Nicola. I suppose as someone in the private sector, I'm unusually sympathetic to and admiring the work that central banks have done in this space, maybe because I came from a central bank. I mean, I think a couple of things. Firstly, I think those NGFS reference scenarios and the ECB and the Bank of England work were really useful in a quite top-down macro way, showing what was possible, right? So showing that we can have a smooth transition if we start now and if capital starts flowing in the right directions. And I think there's a lot of value in illustrating that. And as Nicola says, getting some work out there at quite short order that people know and recognise. I am very sympathetic to the Irene's 80 billion euros point, having been on the other side of these sorts of conversations from a central bank, right? There are times when as a policymaker, it's much better to be roughly directionally right than it is to be very precisely wrong, right? And I think presenting numbers like that with the sorts of caveat that Irene put around them is much better than is saying, let's try and channel through all of this huge uncertainty and second round effects and 90 uncertainty, etc., and put a much scarier number on and risk that becoming the sort of de facto market price. So I have a lot of sympathy with what central banks have done there. I mean, coming back to this question of how can the private sector help accelerate? How would I like to help accelerate? I love Nicola's characterization that, if I can augment it slightly, we've moved from a world where the fear was that government policy would run ahead of markets to a world where the financial sector and financial flows and capital movements are running ahead of government policy. I think that's exactly what we're starting to see, looking at the way that investment is flowing away from or was prior to the last few months, flowing away from, say, oil and gas. And so something I think it would be useful for the private sector to do is to try and see if we can sit down with central banks and sketch out, you know, what does a longer lasting period of higher, more volatile energy prices mean for bank profitability and mean for the macro economy? What do micro level imbalances in demand and supply of copper and lithium mean for transition? And what does that mean for banks' corporate loan books, etc.? At a sovereign level, we work with clients in places like South Africa, where you have this huge amount of national infrastructure set up to serve the oil and gas and coal mining industries. What does a bumpier transition mean for the viability of those sorts of infrastructures? Will they end up back on sovereign balance sheets? What does that mean for the health of the banking sector? So thinking through some of these effects of central banks and what transition means for them, I think is something we'd like to help with, I think.
Thanks, Joe. So let's have a few more questions. We had the lady with the green skirt and yeah.
Hello, my name is Jin Zhang. I'm from SOAS University of London. I have a question. To what extent can stress test be used as alarm of financial crisis, both theoretically and from the operational level? Thanks.
Okay, thank you. Then we had...
Hi there, Tessa Walsh from IFR. What jumped out at me was the bank's financial decisions piece, and the statistic of 20% of lending is aligned at the moment. And I was wondering, how can you increase that? And are there any moves to allow sustainability-linked loans on banks' portfolios to be part of that?
Right. Then we had one more gentleman near the middle aisle. Yeah.
Thanks very much. David Clayton from Kaya in London. Can I just ask about the US approach? Because we haven't talked about the US approach, and it seems pretty crucial. When I talk to people in banks, the thing they fear most is not a bifurcation, but a sort of trifurcation in approaches to stress testing and climate financial reporting. And it looks like the US has no intention of pursuing any form of stress testing. So from the perspective of trying to build a consistent approach between central banks, it's great to have an NGFS scenario, which everybody shares. But if we don't execute an approach to stress testing that is similar across systems, it's extraordinarily complex to run any global institution in that setting. Any comments on that? I'd love to hear.
Thank you. I know there are more questions, but maybe we'll take this round first and then take a few more. So who wants to go first? Irene or Nicola? Yeah, go.
Maybe I'll try with the first two questions. So to what extent can a stress test be used as an alarm for future financial crises? So I guess a sort of canary in a coal mine type thing. Well, I think that there's a communication challenge around there that maybe we can ask Irene about. But I think yes. I think if they are capturing the risks properly, then they can be used as an alarm. And I think some of the work on nature that we heard about in the former session is really starting to, financial risks of nature is really starting to show that actually there's a massive potential risk there, and it is really raising an alarm bell and making it very relevant to financial institutions, ministries of finance, central banks, which is really important. I think actually there is one of the things that we've been thinking about is the idea of like systemically important systems. So you have in the financial system a concept of systemically important financial institutions, and they're the ones you really sort of watch in terms of the supervision. But there are around the world really systemically important systems which will create a huge financial risk if lost. So let's take the Amazon as an example of a nature one. The bread baskets. So in the world we have 5 food bread baskets that we've seen, if disrupted, can lead to inflation. So there are these sort of systemically important systems, and I think we haven't really done enough yet to translate that concept of sort of financially. We can do more to translate that concept over into thinking about climate and nature in a sort of stress testing way to see to what extent are those really having such a massive impact on the economy and the financial sector. I think that would help to really raise the alarm if we did that. And then just on the point, Tessa's point on alignment and the 20% alignment. So I think, obviously that's so important. And there are other processes that are happening beyond the sort of supervision side, or that sort of touches on it as well, particularly around disclosure. So you might have seen the session yesterday on transition plans. So that's a really important part of that soon in the UK, financial institutions will be required to disclose a transition plan. So how are they actually going to meet their targets? And most of them have set net zero targets. So that sort of other side of the regulatory coin will, I think, really help with that alignment question.
Joe is asking, can I go next? I think so, yeah.
Yeah, so I agree with Nicola on this canary in the coal mine question. So I think my answer would be yes, absolutely, stress testing can serve as a really important predictor of where problems are going to lie. I think the mechanism through which they do so, what the last 10, 15 years has taught us, is at least with banks, the mechanism through which they do so is through banks' participation, what that builds in terms of their capabilities and understanding of risk, data releases, etc., rather than the hard pass-fail, yes or no, right? I remember when the European Banking Authority first ran a bank stress test in 2012, right? Who passed or failed? I think everyone passed because of where they set the marks, was kind of irrelevant, right? It was the fact that banks had to go through the exercise, release robust comparable capital numbers and robust comparable risk numbers that were calculated on a consistent basis that was important. So I think absolutely, but it's less about the quality of the marking and more about the quality of the homework that financial institutions have to do behind the scenes. That would be my observation there. On David's question on sort of fragmentation, I mean, yes, I think this is an absolutely huge risk, right, that different regulatory authorities around the world end up in different places, and that hugely complicates and increases the cost of running a multinational financial institution. This would absolutely not be the first time that we've seen fragmentation in regulatory standards, right? My old employer, the Financial Stability Board, we did a report in 2019 talking about the huge fragmentation and differences in the pace at which Basel II and Basel III, the banking regulatory accords that were put in before and after the last financial crisis, were being implemented across jurisdictions, and the different challenges and costs that raised for banks. There's one important difference, right, which is that one of the challenges of avoiding fragmentation with normal, with the regulation of non-climate risks is the question of, well, who ends up being on the hook, right? If you've got an American bank that is operating in the UK, the conversation between the American and the British regulator is, yes, okay, but whose taxpayers are ultimately on the hook for this bank for ensuring its deposits, right? And that leads to this tension of, well, we want to hold your UK subsidiary or your US subsidiary of the UK bank to a different regulatory standard because it's our taxpayers who will pay to bail you out, insure your deposits, give access to our discount windows, right? The issue with climate is that it's a global issue, right? We can't keep the UK's emissions in one tower above the UK or vice versa with another home host jurisdiction, right? So I'd say there's even more emphasis, or there should be more emphasis, on avoiding fragmentation in the case of climate reporting because it's, by its nature, a global issue.
Yes, maybe on the stress test, if it's really setting an alarm, I think it should, but there are still so many unknowns. With the drought last year in South Korea affecting the manufacturing of chips, right? How that affected the car industry, I don't think anybody had that on the radar. So this is just one example of the transmission channels and also the irreversibility, the tipping point. We recently recruited a climate scientist on my team, and now we're getting new insights of what are the droughts doing in Italy on the economy there. So there are just so many unknowns, and I think they are not fully covered yet in these stress tests. So that's why we need to start improving them, developing them, working with others to do so. So hopefully it will improve and we'll get better insights, because it really shows, I think, again, all these examples we've been telling about, that we have to take action now and warn governments to do that, right? To better take action now, because the price is less if you leave it for the future generations. On the question of the US approach, here I can say we're working within the Network for Greening the Financial System with the US authorities and also all their other central banks to have a common baseline to start from. This is what we do. We have bilateral contacts with them. So there to really see, okay, how can we also here work towards more common standards internationally. We're talking about disclosures these 2 days a lot. I think there also with convergency, comparability, this is where we should go to, because we're all operating in an international market, we need to be able to compare things, know more about the risk. So this is what we're aiming for.
Thanks, Irene. All right, we had a few questions on this side of the aisle. In the very back, the gentleman in the middle, and maybe the lady to the right. Let's start there. Yeah.
Thanks. Carl Mallon from XDI. So I want to pick up on your point here, Irene, because this is something that's coming through really loud and clear for me at the moment. So XDI did a large number of banks in the stress test in the UK, and we were using NGFS, but NGFS is not a physical scenario, so different entities chose to interpret the physical scenarios, which, remember, take years and years to model, into hypothetical scenarios which are political or policy orientated. So that was one thing where NGFS is quite difficult to use. But what we see, something that is coming through, we've got all of these companies who are doing TCFD report, and then there was a session this morning about how all of these AI companies are trying to extract data out of it. So it feels to me like what we've got is a jigsaw puzzle where none of the pieces are designed to go together. And yet, if we had a situation where there was machine-readable disclosure or something, which is to say, you have to do these scenarios, we're not saying it's the right one, but you use this one, or you disclose these metrics, or these are the minimum you have to do. You can do as many others if you want to go beyond that. But we don't even have that at the moment. So what we've got is a maelstrom of disclosure, which is almost unusable. But if we were to align that, we could have a situation where, for example, supply chain was easy to do because I say, I use this company, I understand their jigsaw piece, I know what their risks are, so I know how much they're transferring to me and vice versa. So in a way, given that you are running ahead of government, but also, as other people have pointed out, you are depending on government infrastructure, water, power, monopoly regulated transport systems and so on. Do you have a view about whether the financial sector can start to assert some, if you like, pressure both onto the participants, the downstream companies and the government into, if you like, knocking this jigsaw puzzle into a situation where the pieces do fit together?
All right, then the lady in the same row. Yeah.
Thanks, Deborah McCoy with Bain & Company. I'm interested in the interaction, and my question might be for Joe specifically, but perhaps others would have a comment. It's into the private sector side of things. It's about the interaction between asset owners, so that's really the core of my question, asset managers and banks. So as banks go through their scenarios and start making some set of strategic assumptions, it was great to see the data today, so it looks like that's not quite happening, but let's just say that banks start lending differently in structural ways. And asset managers are more committed into frameworks around net zero and some traditional pathways. It does seem that there are some large asset owners, some who are on the record, who are in a different position from a kind of just a power asymmetry point of view. They don't have to be part of any particular network or sign-on, and some of them are building their own transition pathways, where they're saying they'd like to kind of come up with their own transition scenarios where they can make money throughout. What do you think about the systemic kind of risk implications, if any, of large asset owners who would have only themselves and their returns as kind of the main constituent, and what that might mean for the rest of the financial actors who might all actually be aligning to a different standard?
Thank you. Then I think we had, one more question to the, next to the window.
Hi, Jacob Tomei from 2 Degrees Investing. I wanted to pick up on the earlier question about the materiality of these risks. Is the problem that central banks are too scared actually to interrogate and entertain some of the more extreme scenarios? We know that the NGFS scenarios represent different futures, but they are effectively the central outcomes within the futures, right? So the hothouse scenario is the central outcome within the hothouse scenario. The most extreme scenarios basically suggest that when you take together ecosystem risks, social risks, and climate risk, that you're looking at 30 years of minus 0.1% growth. That's basically a 30-year permanent recession. So we are now in the situation where central banks are bold enough, if I may say that, to look at these risks and to entertain them as central to their mandate, but not bold enough to actually interrogate the real materiality that will come in these extreme futures? And is that kind of a no man's land that perhaps can sometimes do more harm than good, because it leads to people believing that these risks are not necessarily material and do not actually impact capital to the extent that it should keep us up at night? And again, of course, I'm not suggesting that these extreme scenarios are the right future, but simply if you do a stress test, they would be the ones to look at as you're testing the extremes and the frontiers.
All right, so we have a few questions surrounding the lack of harmonization, the jigsaw of pieces. What does that do? Perhaps introducing systemic risk as well. And are the NGFS scenarios extreme enough? Who wants to go first?
I'm happy to tackle the question that was, or what I think was the question that was aimed at me first. So I think this is really interesting. Let me paraphrase the question to check I've understood it. So I guess one issue here is that banks disinvest, or regulated financial institutions, I should say, that are subject to high degrees of prudential regulations, banks and insurers, disinvest the high emitting stuff. And somebody else, another investor, an asset owner, private equity firm, picks it, a US private equity firm, for example, picks it up, and that investor is subject to much lower standards of prudential supervision and disclosure than is a bank or an insurer. And I think that's a huge issue. Firstly, because, as I set out before, the higher emitting assets might be enabling transition in some sense, because it's, for example, pulling copper out the ground or lithium out the ground or some mineral or commodity that we need for transition. And secondly, because even the dirty assets are in need of stewardship. Right, a regulated bank or insurer is much more likely to hold the transition plans of those companies, those dirty assets, up to scrutiny and steward them towards positive transition than is an asset owner who isn't subject to the same requirements. Sarah Breeden at the Bank of England recently wrote about this in a speech back in April. Right, so the risk is that all of the emissions that are harder, the carbon that is harder to transition to net zero, end up flowing into what we used to call the shadow banking sector, right, into the world of finance that is much less regulated. And that's part of the reason why I think we have to be very careful, or central banks and regulators have to be very careful about how they regulate here to avoid this waterbed effect, whereby the difficult stuff that we don't like, that poses a real transition issue because it's in a hard to abate sector, for example, ends up flowing off away from regulated balance sheets. And I think that would be a real problem if that happened. But keen to hear what others think too.
Yes, I'm happy to take over, Joe. On the jigsaw puzzle, I think we all hold a piece of the puzzle, but how do we fit it together? And we're now more in the stage that everybody's picking up theirs, but not really putting them together so much. So I agree with you, there needs to be more convergence in this. What we're doing from the European Central Bank side on this is we're in all these international fora. We're in the G20, the G7, the FSB. We're putting out our response to the ISSB consultation, the EFRIC consultation. And there also see, okay, let's build an international framework that is comparable. And on your point, I think to have it with AI or another way, if we have different standards, how can you at least have some, extract the right information, have it comparable? Ideally, you would have one system, right, with a top up. So I think that's one example of how we're, that's the voice we're going to let be heard, hopefully, in our response to EFRIC and the ISSB that will come out in next week. So push also others to work together and put the pieces together of the puzzle. So I think this is an important role we have to play. I think everybody has this role to play to see, okay, how can we work together at this front? On the question of Jacob, on are the scenarios material enough? Are we really testing the real stress or the extremes on this? I think what we have done with the NGFS scenarios so far, starting to develop, we've brought out the second phase. After summer, we do the third phase. And I think there we need to improve. We have the agenda coming up. Okay, are we looking at the right scenarios? The scenarios we published, I don't think they took into account the huge rise in energy prices just recently, right? I think just showing how big a transition risk could be without a carbon price. So that's an interesting story to see, okay, are we really testing the extreme? So I think, Jacob, you have a point. I think this needs to improve going forward. Because then you can really see the magnitude maybe of the problem.
Just add an additional point on that. So obviously I totally agree with you, Jacob, as well. I think one of the challenges was that, and I'm not part of the NGFS process, but they went out to get the best available science, and the best available science is the IPCC. So they follow a very IPCC approach. But the challenge is the IPCC was not designed for financial stress testing. It was designed for climate policy scenarios to say there's a 1.5 degree goal, what are the risks associated with that, and more from a setting a goal type perspective. And the result of that is that there's quite a lot in NGFS about trying to understand the emissions, the different scenarios in terms of emissions, but then as you say, then after that it's sort of the central assumptions all of the way on, particularly on the physical risk side. So it doesn't at the moment capture, it doesn't look from that more stress testing perspective of, what are the key risks that we really need to worry about, which, in my experience of working on stress testing is the normal way that you think about, how do I stress this system and, how vulnerable are financial institutions to that. So I think that there is some work to do in, how the scenarios are designed. But again, we're only 2.5 years, 3 years into this journey. I've just come to a point on, well, maybe a quick point on Deborah and Carl, if I may. So one, Deborah, is it a systemic risk that different financial institutions are using different scenarios? I think was a point. No, I think it would be a systemic risk right now if everyone was using the same scenarios, because we know that there are issues with them. And what we see is that some of the more really advanced financial institutions are developing their own scenarios, and they're doing it as well to match their own business. So they understand their business and they understand what scenarios are most important. So if you have a big mortgage book, you will design scenarios that are appropriate for your mortgage book. So we're seeing that practice happening within the market, and I think that's fine. Actually, I think that's fine. They do all say when it comes to the regulatory stress test, the regulatory scenario analyses, having simple, consistent scenarios is really important. But what they're doing internally is a lot more evolved, is what we're hearing. And then just on the sort of exerting pressure point that Carl made, I think that's exactly right. So in the occasion that I get to speak to senior people in banks and they ask me, what do you think we should do? I said, stand together and tell the government what you need in terms of making this transition. And because one of the key, all of these transition risks will disappear, or as soon as, well, the uncertainty in that, as soon as you get a clear transition path, as soon as the government has a clear path, companies will align with that. But the problem is that because we have this policy uncertainty at the moment, it's creating even more risk. So I think that's a key thing that the financial sector should do, is stand together and say, these are the things that we need in order to make this transition happen. And on the physical risk side, another really interesting finding that we found from talking to people about CBES is that they suddenly really care about adaptation. I've never heard a banker talk about adaptation until about 6 months ago, but they really care in the UK about flood re, because they've realised if flood re goes, their risk to their mortgage books, for example, is going to increase massively. So they are now lobbying the government, you need to support flood re. So actually there's some really helpful things that have come about as well, and helpful roles that the financial sector can play.
I think the room next to us is telling us to start closing this session. So perhaps just to knock it out, a final question from me to all of you, and for you, Nicola and Joe, perhaps to make it concrete in the UK context. Where do you think or hope that stress testing in the area of sustainability will be in 10 years' time? Nice, short and snappy answers, hopefully. And for Irene, where do you hope the ECB will be in terms of sustainability stress testing in 10 years' time? Keep it short and then we'll close off. Nicola, do you want to say something to that?
Well, I think not even in 10 years, but in 1 year, I think that the UK's stress test should be aligned with what the government's own assessment of the climate change risks is. That I showed. I think for the next one, that's a key thing, is to make sure that the central bank and the government are saying the same thing in terms of where the key risks are.
I agree, based more on clearly defined government policy paths, considerations of some of these tail extremes around climate, and making sure that they incorporate the sorts of feedback mechanisms and discontinuities and mismatches between investment and disinvestment in green and dirty energy that I mentioned earlier.
Irene, for the ECB?
Yes, I hope and I believe that we really going to improve it. We're going to meet the challenges we concluded from this stress test on the data, on the methodologies. We really improved on that front. And I think what Joe said on the governments really moved up. So we have a really clear transition plan, because I think that's still so much important to guide the whole economy to the right direction. If we saw that the European Commission announced this week that we have to reduce natural gas use by 15% over the coming year, I wish we would have done that without a war in the Ukraine, right? Because I think such a clear transition path we would need to make it credible, make it smooth, and make it work.
Thanks so much, all of you, and thank you as well.